I'm going to be going over an ES case study to the downside, right? So just quickly breaking this down, this was a sell-off. So execution today would have been 67.43 down to about 67.33. So a 10-point reward for about a 6-point risk, so about 1.8 R. So I'm going to break this trade down in terms of what we were looking for, right? So today I was making a brochure just to break down to people, right? And in that brochure, it's the 3 simple things that we want every trade to have, right? So I call it the triple X model, triple X, because it's 3 things we're looking for. We want to know where to trade from, right? So we need to have our key levels in place. So key level is basically a 15-minute fair value gap. Simply put, right? We're looking for a 15-minute fair value gap. That's all you're looking for, a 15-minute fair value gap. The next thing you're looking for is what to look for specifically. So we're looking for buyers and sellers. So when we enter the key level, we want to know who's in control between buyers and sellers. And the last thing we're looking for is why. So today I took a sell trade. When I ask traders, why did you buy? Why did you sell? They don't have an answer. They cannot point to an answer on the chart as to why they took a buy, why they took a sell. Now, the problem is when you're trading without knowledge of why you're buying and selling, you are a gambler that has a charting addiction. You're not actually trading, right? So why did you buy and sell? So this comes down to basically passive buyers and sellers. So in this case, we're going to be going over passive sellers, right? So this is the whole point of the trade, or any trade you take. So you need to know where to trade from. So 15-minute fair value gap, what to look for. You need to know about buyers and sellers. And the last thing is why. So keep in mind, passive sellers are going to be the point of today. So if we just kind of take a look back at what was going on. So Monday, I wasn't able to catch the longs, unfortunately. But Monday, what we had here, very interesting. We had a key level. So this is the 15-minute fair value gap. The last 15-minute fair value gap prior to the session. So you could have taken basically this one. So this was the key level. So we had a 15-minute fair value gap, right? So from here, we saw a break and retest on the lower time frames to the upside, right? So now from here, this was my key level. Eventually, I expect price to come down to here. So let's take a look at where we were on Tuesday. So on Tuesday, I like to use the weekly opening price, right? So I like to use the weekly power of 3. So for those who don't understand why I use the power of 3, a weekly candle will open, we will head lower and higher. And of course, when we're above the weekly opening price, which is down here, we ideally want to be looking for sells. So a quick tip about the weekly PO3, the further away you are to the weekly opening price, the stronger the weekly PO3 becomes. So the further you are higher above the weekly opening price, the more likely your sells are to play out. So if you're looking for an A plus sell trade, having it above the weekly opening price, so in this case over here, was a significant advantage. So that's quickly how I was looking at the PO3 from a PO3 perspective. Now, when we go to the actual chart itself, we want to understand what was going on in terms of the manipulation. So notice how we have an Asian range. So I have what I call 1-phase and 2-phase manipulations. I prefer a 2-phase manipulation. A 2-phase manipulation is more powerful. So what we can see is every day we have an Asian session, right? The Asian session accumulates liquidity. That is the only purpose of the Asian range, right? So that is the orange box you see every day here. Now from here, we have a 2-phase manipulation. So how I define a 2-phase manipulation is very simple. If the market sweeps the Asian low and the Asian high before our entry, this is a 1-phase and a 2-phase manipulation. So what are the phases of manipulation? So when we're looking at a 2-phase manipulation with respect to the Asian range, the Asian range has only 2 points we are interested in, the Asian low and the Asian high. So I put 2 red lines like this. So for example, let me break down today's trade. So this was our key level. So we had a 15-minute fair value gap just over there. That is the key level. Okay, so we're way above the weekly opening price. We're looking for potential shorts if we get the entry. So this is the key level. So the reason key levels are important is because you are trying to analyze price action inside of those key levels. So we saw the sell-off from around 11:15 Eastern all the way down to about 12 p.m. Eastern. So with that being said, right, how can we use the 2-phase manipulation to our advantage, right? So this was our key level just over here. So when we look for an entry, we're looking for basically a break and a retest to head lower. Now, what makes this a 2-phase manipulation is that we've actually taken out the Asian range low, and then the Asian range high. So we've had two phases of manipulation just like this. So whenever you're looking at the charts, you always want to see how the market has reacted to the Asian session before you make any decisions. If you've not taken out the Asian low or the Asian high, it's probably a range and you want to avoid that day. So knowing when not to trade is just as important as knowing when to trade. So this is a two-phase manipulation. It's one of my favorite manipulation setups, right? So let's go back to the charts over here. Here's our key level there. This is our key level. So now we've established what we're looking for. Where we're looking to trade, right? We're looking to either buy. So if I go down now to the 5-minute chart, so this was a trade taken on the 5-minute chart. What we're looking for here is, obviously, when we come into a key level, we can either break to the upside or break to the downside. Now, in this case, we broke to the downside. So what was going on here, and more importantly, what was going on over here? So this is now going on to the next stage. So when we come into a key level, so your key level should be defined pre-market, right? Let me explain to you what I mean. So this was a fair value gap created in the London session. So this would have been about 7:30 a.m. Eastern. So this is 7:30 a.m. Eastern. So what does that mean? That means when I come to the session, when I come to the chart at around 9 to 9:30 Eastern, I already know where I want to trade from. Right, so we're going to be focusing on the 5-minute chart, and we're going to be understanding specifically what was going on inside of this level, right? So break and retest, I've been through it so many times, but how do we form a break and retest? So we want to see price enter the level, and we want to see how the market reacts in certain places. Namely, we want to see what's going on at the tops. So we want to see, look, the level tried to hold here, the level tried to hold here, and then we had our break here, right? So we had our retest here, sorry. So the break was actually this line over here. This red line shows us we had the break and the retest, and now we're looking to head lower. So let's break this down. So we see price heading below the level, and then this was our retest. So our retest would have been from around 10 past 11 to 25 past 11 Eastern. So my entry would have been just below this red line over here, stop loss just above the key level over here, and we're looking to target the next key level, which I believe was somewhere down here. I exited at around 1.8 R. So we're going to break this trade down in terms of the buyers and the sellers. So I often say to traders that your trading doesn't need to be complicated. The reason trading feels complicated is because you're blaming psychology without having an edge. So what do I mean by that? So if I take you over here, all right, if I take you just quickly now, I'm a big proponent that once you have your key levels, the rest of trading comes down to waiting. So people blame patience or impatience, they blame FOMO, they blame hesitation. So let me give you a different spin on things, right? I think that every psychological problem can be fixed with a technical piece of information. I.e., I believe emotions and psychology do not matter. Now, the reason I say that is because a lot of psychological problems that occur are brought into trading from external factors. So for example, if you FOMO into trades, it's because you're trying to pass a challenge or you're trying to make money quickly so you can escape a job. If you fear taking a loss, it's because you're risking too much to make more money because you want to speed the process up to show somebody that you're a trader. Either way, none of these things are going to serve you, and they're coming from outside of trading. So if you're a greedy person, you need to look at what's happening outside of your life. If you're FOMOing into positions, you need to understand that, number one, you haven't had the experience to know what to look for. Now, the reason you haven't had the experience is because you're rushing. So rushing is basically a symptom of ego. So the more ego you have, the less likely you are to actually be successful at trading, because a lot of psychological problems are brought from outside of trading. So when you enter the chart, it's not your psychology that's stopping you from making money. It's the fact that you don't know what you're looking for. So for example, when we see a break over here, we have a break. A lot of traders don't understand every strategy comes down to break and retest, but they do not understand what a retest is. They don't know what's happening here. So today we had an interesting example. So we had an example where we had a reaction and then a retest. So we're going to be breaking down why this was a valid sell trade on the Discord, right? So here was my execution. This was the trade itself at just after 11 a.m. Eastern. I think it was 11:05 was my entry, something like that. So we're going to first break down this blue box is the same as the key level you see over here, right? So this is the ATAS platform. You can use ATAS or you can use footprint charts straight off TradingView. It doesn't really matter. You can use Sierra charts. They all mean the same thing. So if you're struggling with psychology, it's because you don't know what you're doing. You don't know what you're doing because you don't understand how key levels work, and you don't understand how key levels work because you haven't been bothered to put in the time. It's that simple. It's not a psychological problem, I promise you, because you can buy and sell. You can buy and sell. You can wait. You can read numbers. You can read colors like we're going to. So you can do it. You just don't know when to do it, why to do it, and what you're doing, right? Which is psychological problems brought outside of trading. Maybe you're an impatient person like I was. Maybe you're impulsive. Maybe you struggle to put on risk. Maybe you have fear. Maybe you're risk averse. These are things you were born with. These are characteristic traits. These are things brought into trading, not created by trading, right? Trading doesn't create psychological problems. It exposes them from who you are, not the charts. Just wanted to break that down. So once we have a key level, you want to see how the key level was holding. Then we had a break over here. So this was my first initial entry. So we saw the level hold, then we broke. So what do you see over here? So this is super interesting. So I'm going to bring up the charts and the order flow together. So we're going to break down this first circle over here. So we do that via order flow footprint charts, right? So here we are. Now, what we can see is this. We see 0 for 147. We see 87 for 353, right? So we can see that via the positive delta. So here we definitely see aggressive buyers trying to drive price significantly above the level. Now, were they able to drive price significantly above the level? Well, not really, because the level was at 67.48. They only went up to 67.50, 51, and then we actually broke lower. So it's showing you signs that aggressive buyers aren't getting their way, right? So if you can't see that, it's because you lack experience in understanding what to look for. It's not a psychological error. So even my old self, for example, if I really break this down, my old self would have done this. I would have said, okay, buyers are stepping in. I'm going to buy here, and I'm going to have my stop loss here. Now, when I have a key level, I explained earlier that we're significantly above the weekly opening price. So any type of longs that I take will be with caution. That's the first thing. The second thing is this. If you actually understand what was going on, we had a lot of aggressive buyers and sellers that are now beginning to break the zone. So you see buyers unable to sustain, but you see sellers starting to crack below the level. That's one thing to bear in mind. And we see that via the delta, right? So when you have positive delta, it means that there's more aggressive buyers and sellers. When you have negative delta, there's more aggressive sellers than buyers. Now, we're going to be focusing on the retest. So this is the confirmation. So I ask traders every day, what is your confirmation? So if you don't have a confirmation, your trade wasn't a trade, it was a gamble. So what do I mean by confirmation? Confirmation is simply knowing whether to buy or sell, right? So do you buy or do you sell? So your confirmation is about knowing who is in control. Right? Who is in control, right? That is the only thing you have to do. So realistically, if you do not know who is in control, you're not trading. Like there's nothing here that tells you whether to buy or sell. So why did the markets move lower? Great question. So from here, I want traders to understand that we have something called the delta. The delta is the difference between the ask and the bid. So we have aggressive sellers on the right and aggressive buyers on the left. So here we can see blue delta, right? I know the numbers are a bit small, but it says 267 for 766. So it shows you a significantly higher ask than bid number. So here the delta is positive. Here up top, the delta is positive. 55 for 248. And what we see basically 10 minutes, because this is the 5-minute chart, just over here. We see 10 to 15 minutes of a lot of aggressive buyers. All right, there's a lot of aggressive buyers over here. So I'm going to label this in blue, right? Because we have blue delta up top. So from here, if you see a lot of aggressive buyers here and the market breaks lower once and twice, that gives you the confirmation to look for a sell. So when you're being patient, if you don't know who's in control between buyers and sellers, patience is a mask for not knowing what impatience, is a mask for not knowing what you're doing, right? So I don't want to be, derogative or anything, but The reason the market sold off isn't because of an indicator or a pattern or anything macro, anything like that. The reason the market sold off is because aggressive buyers hit the ask and they failed. So the way I'm going to sum this up is aggressive buyers. I'm just going to write AGG. Aggressive buyers fail to break above the level. They are trapped. And when these buyers are trapped, it basically means sellers are in control. And I promise you, trading isn't anything more complicated than that.